every asset in the fiat world ties back to the price of these bonds. Over time, when this index hits about 135 to 140, there's pretty much an immediate response from policymakers to do some sort of money printing to make sure that the bond market continues to function. And so if you want to look at a smoke alarm for, okay, about to happen, I better, that doesn't necessarily mean Bitcoin's going to go up immediately, but I do know that when something happens that's bad for bonds, at least the US Treasury market, there will be some way that they print money, and Bitcoin will outperform subsequent to that action.
At the core of Hayes' argument lies a stark and uncomfortable truth. The global economy is drowning in unsustainable levels of debt, and the current pace of economic growth simply isn't enough to service it. In a functioning and resilient financial system, such debt would eventually be purged. Inefficient businesses would fail, unproductive debt would be written off, jobs would be lost in the short term, and the economy would undergo a painful but necessary reset. However, that process is politically unacceptable. No government or leader wants to be seen as responsible for triggering a financial crisis, mass layoffs, or a deep recession. Instead, policymakers often choose to delay the reckoning through more borrowing, money printing, or market interventions, pushing the problem further down the road rather than solving it. I think this is the right time to click the like and subscribe. Now let's go back to the interview.
At the end of the day, there's a lot of debt. There's not a lot of enough growth to service the debt. And so instead of allowing the system to self-correct and, expunge a lot of credit, people go bankrupt, people lose their jobs, what have you, the authorities around the world say, okay, that's politically unpalatable, so we're just going to print the money and make sure that on a nominal basis, if you lent $1, a euro, a yuan, a yen, you're going to get back that same unit. Okay, but the real value of that unit, whether you look at it versus gold, versus oil, versus Bitcoin, that is going to decline. I mean, number one, I don't subscribe to a 4-year cycle. I don't think, yes, it has worked in the past. It doesn't necessarily mean it'll work in the future. So I think, that's just my personal view. What are people missing? I don't think people are missing a lot. I think people just want they want the end game to happen in 1 minute. Right? Oh, I put this trade on. I use a lot of leverage. Oh, yeah, I do believe in the fundamental thesis of money printing. They're just going to keep printing the money. But okay, can they just do this like immediately? Let's not wait 10 years. Like, let's do it right now so that trade I put on automatically shows me a profit and I can go quit my job and buy a Lambo. I think that's the problem. And so, yes, the authorities are going to print the money over time, but they're not going to do it on your time schedule. And maybe this is going to be a little bit of a wave. Sometimes they're going to print too much like they did in COVID. And then they're going to say, oh, let's pare it back a bit. But then, oh, no, we can't pare it back because that's going to, blow up the system. Let's print some more money again. And it's sort of this, up and down sort of pace of money printing that, creates these, bullish and bearish impulses in Bitcoin and crypto assets. And those people who have or who are impatient and who use a lot of leverage get wiped out. And that's why people say, oh, it's a bear market. Okay, cool. Yeah. But over time, Bitcoin has been the best performing asset in human history for over this time span. So I think people get it right, but then they're just too impatient. The MOVE index. So this is bond market volatility in the US Treasury market, which is obviously the most important debt market in the world as it underpins the global reserve currency, the US dollar, and is the thing that the empire, the US government is issuing to fund itself. And so every asset in the fiat world ties back to the price of these bonds. So they're very, very important. So when these bonds become illiquid or volatility increases, that's bad for the system. And then the policymakers have to step in and print money to make sure that this market stays well functioning. So, over time, when this index hits about 135 to 140, there's pretty much an immediate response from policymakers to do some sort of money printing to make sure that the bond market continues to function. And so if you want to look at a smoke alarm for, okay, about to happen, I better, that doesn't necessarily mean Bitcoin's going to go up immediately, but I do know that when something happens that's bad for bonds, at least the US Treasury market, there will be some way that they print money, and Bitcoin will outperform subsequent to that action. Do I think that the expectation of pace of money printing is divergent from what's actually going to happen? And when that happens, is okay, then it's time to take chips off the table. So there's no price target per se, because again, you're never going to sell at the top or buy at the bottom. And if you try, you're going to get blown up. So you might as well have a more sustainable framework for when you're going to, go shorter altcoin risk versus longer. And so that's sort of what I look at. That's what guided me to sort of reduce, pretty much sell everything in our shitcoin portfolio pre-inauguration, January 20th of Donald Trump in the United States. That's what decided, when April 2nd to 9th happened, and global markets shit the bed, and then all of a sudden there was the tariff pivot, and then Bessent coming out saying he's going to do treasury buybacks. So like, okay, well now it's risk on. Now let's go back into the alts that I think are quality and buying more Bitcoin. So there wasn't really a specific price target. I don't like to use price targets or specific time frames, because when you put these binary, those specific events on a chart, the market's going to abuse you at that point. Be patient. You're not going to, there's no easy button. The best traders in the world, didn't make all their money on their first trade. So don't try to do that either, because you're just going to blow up. I think altcoin season will happen. It just won't be as widespread as maybe you hope. So that piece of coin that you own in your portfolio that's been around for a few years, they've had a chance to onboard clients, sell them a product or service that the client pays for, and to give you some of that revenue back to you. Most of your projects in your portfolio don't do any of those things. And so they're not going to participate in the altcoin rally. Let's say that ETH, catches a bid, gets to, 4,000 or 5,000, whatever level. I don't think we're going to see the 2021, you just throw in, throw some money, and then you just all of a sudden you're up 10x, right? It's going to be very specific about which coins go up. I think we're going to have a lot more quality coins doing well. And then obviously the new thing, whatever that is, where it's unproven and people can dream, cool. We'll be slinging shit all over the place. And I don't know what that is. I'll be there trading it just like everybody else, but that'll be altcoin season. But the dead coin in your portfolio that you're just hoping is just going to rally just because alts are going up in general, I think that trade's done.
Globally, the real winner in the stablecoin space remains Tether, and for good reason. It serves a crucial role in markets where access to traditional US dollar bank accounts is limited or non-existent. Whether you're in Argentina, Nigeria, or the Philippines, Tether meets a demand that US fintech companies either can't legally fulfill or aren't equipped to handle. That's what true product market fit looks like. While venture capital continues to flow into US-based stablecoin startups, Arthur Hayes argues that the real growth opportunity lies offshore, where Tether already has a strong foothold and continues to dominate the market by solving real-world problems.
Because in the US, people have Venmo, Cash App, bank transfer. Like, people in the US earn dollars. They have dollar bank accounts. You can get a dollar bank account. It might be not as easy as you like, but pretty much anyone who wants one can get a US dollar bank account. So if I give you a stable coin that's a little bit faster, marginally cheaper, are you going to use it? Maybe, maybe not. It's not a 10x better product. So, okay, yeah, there's going to be a lot of VCs pouring money into all these stablecoin startups because there's a new bill and there's, clarity and whatnot. But they're not going to make any money. And okay, the US consumer gets a marginally better product for a marginally better price. Okay, fine, cool, whatever. Does that affect the rest of the world? Tether will be laughing. Oh, great. You guys can go spunk $100 billion on building all these dumb fintech startups that are competing with a product that's marginally better. I'm going to continue offering US dollar bank accounts to everybody else in the world who can't get one. The US stablecoin bill does nothing to address that fact, because they can't, right? That's a private bank's decision on whether or not they're going to open dollar bank accounts for somebody in Argentina or Indonesia or in the Philippines, right? But that's where Tether is strong. They have a real product market fit. This stablecoin bill doesn't mean anything. It's just, I think there's going to be a JP Morgan coin, a Citibank coin, whatever. Cool. That's great. US consumer, marginally better product, better price. Does that have any impact on a Tron or a Tether? No. Technology and liquidity, dollar liquidity, fiat liquidity. So essentially technology is the blockchain, right? This ability to coordinate all of these self-interested actors to, number one, upkeep this network, and number two, issue this endogenous coin, Bitcoin, that essentially pays for all the energy that we spend to validate and store these transactions. So there's that part. Obviously, it's still an experiment, but it works. And it's been working, since 2009 with the Genesis block. So, and obviously the Bitcoin core code base doesn't change very much for obvious reasons, security, those sorts of things. And so the technology piece is, pretty ossified. What we're really focused on is liquidity. How many units of fiat are there in the world? How many will there be in the future? And because the Bitcoin supply is fixed at 21 million units of Bitcoin, If the amount of fiat grows to infinity, which it can because it can be printed at will by the government, then the price of Bitcoin can go to infinity as well in fiat units. And because it's starting from such a small place relative to the total amount of debt-based financial assets in the world, I think it's something like 300 trillion or some big number. This is why Bitcoin has outperformed the debasement of fiat currencies since it's launched in 2009 versus, if you bought S&P 500 or maybe an apartment, yes, it's gone up in value, but has it gone up faster than the amount of money that's been created in that time span? And so that's kind of what is my guiding light in terms of how I view Bitcoin and its fiat value is, does it outpace the rate of debasement of global fiat currencies? Or in another way, does it maintain or improve its value in energy terms, which is basically, how many barrels of oil can you buy with a Bitcoin? I don't know. I don't really care. It doesn't matter. I mean, do you think the governments are going to continue to print money or um, campaign on "I will give you free shit"? So if you don't think that's the case, then maybe at some point you're going, okay, well, Bitcoin's had a run. I'm going to cash in into some fiat, maybe buy some real asset and blah, blah, blah. If you think that elected officials are going to continue hey, I'll give you some goodies and I'll pay for them with printed money, then Bitcoin's going to continue to do extremely well. What that value is, again, that's a fool's errand. I don't know what the value is going to be. I don't know. I mean, I think we have all these layer twos. It's not really clear that all the layer two activity leads to ETH price pumping, because obviously it hasn't, given all the activity on sort of Arbitrum and, optimism and these other layer twos. So if that's your thesis, we can look in the history and see that it kind of hasn't really been a price driver of ETH. I mean, honestly, I don't know what the narrative is going to be. Price creates the narrative. So if the price is going up, then all of a sudden, oh my God, ETH is so secure. Oh my God, there's so many developers in ETH. Oh my God, they've created all these really cool DeFi applications. Oh my God, there's all this art on ETH. And so it's a secondary effect of the price going up. You justify it with all these other things.
Hayes wraps up by taking a step back to highlight what gives Bitcoin its lasting value: technology and liquidity. These two pillars are what set Bitcoin apart, and why it has outperformed every major asset class in history, including stocks and real estate. But it's not just about price gains. Hayes focuses on purchasing power, measuring Bitcoin's true strength in real-world terms, like how many barrels of oil one Bitcoin can buy. That, he argues, is the metric that really matters, over time. Stay informed. Click here for the next big update.